Hello and welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel I teach velocity banking. You have heard a lot about infinite banking lately, and the reason being is because I have found that this concept is absolutely unbelievable for changing the way you think about yourself, your finances, and becoming your own banker. This is so exciting. I wasn't even aware at how easy it was to become your own banker. And Chris Noggle has been the best to teach me how this concept works. And I want to share that, guys, with you because I know that if you can grab this concept, velocity banking and infinite banking together, you will never, ever go back to the way you do finances today. So welcome, Chris.
Hey, thanks so much. Yeah, I'm really excited to kind of get, again, back to the basics, back to the fundamentals. And I thought today what we'd do is we would just keep it super simple. Let's go over why the infinite banking concept makes sense. And then at the very end of today's video, what I'm going to do is I'm going to show you the mathematics. It's going to be a little bit of a wall of numbers, but you'll be able to understand it. And it's exactly what Christy teaches with the HELOCs and with simple interest. And then we're going to layer in compounding interest. But you're going to see how the infinite banking concepts it's just a no-brainer. I mean, for anybody that doesn't see the value in this, the only thing I can say is they're just not running the math. And today, that's what I was hoping to do, is just take it back and explain the why behind the infinite banking concept.
Please do. I'm excited. And I just want everybody to understand this is really going to change the way you do banking from now on if you'll just get involved. And it's so simple. That's what I love. Let's do the simple, Chris, and let you take over because I know you're so good at this and I'm excited to hear what you have to say.
Awesome. So let me just start by saying how simple this really is. It is exactly what every one of you are doing right now. Literally, all we're going to change is one thing. That is it. And that is where your savings goes first. And then we're going to add one step. So it can't be any easier than that. If all of you, when you hear me say that, say, oh yeah, I could change one thing and I could add one step to my life. Well, then what I will tell you is you will be able to take back the banking functions in your life, dramatically change your financial future, and put your family in so much better of a financial position by just these changes. So let me kind of walk you through, and I'm just going to take you through a very simple example because sometimes I need to remind people what we've been taught to do with money because they kind of forget. They just go about life and they're just like, well, I don't know, I'm not doing anything wrong. And you're not. But could you do anything better? You see, you got to start asking the questions of why do you do what you do with money? And the answer is always going to come down to because that's what you were told to do. That's what you were taught to do. And let me give you an example. All of us, not excluding myself or Christy, all of us were taught to go out and work for money. We go out and we trade our time, which argument, or you can make the argument that it is the single most precious resource all of us have because all of us have a very finite, limited amount of time. So therefore, we shouldn't be able to value. Our hour should be, priceless, but we can't live like that. So we go out there and we trade our time for money. Now you've got the money because you traded your time for it in any capacity, no matter what you do, you are holding the money. What is the next thing you've been taught to do? You've been taught to take this and put it into someone else's bank. Now, whatever the name of your bank is, that's someone else's bank because you do not own that bank. And in most cases, the shareholders are the owners of the bank and you are not the owner. So we've got the money in the bank. Now, let me come over here and I'm going to do this really simply. So let's just pretend this is the bank, the traditional bank. I'm going to call it that, okay? And you made money via W-2, 1099, whoops. That shouldn't be there. That should be 1099 or K1 income. Now, I don't know what all of you do, but that's your income. And what are you doing is you're putting this money into the bank. No problem. Now, what does the bank give you? Like, how does the bank motivate you to put money into their banking system? Well, there's lots of banks, so we have lots of choices. So usually it's because of an interest rate. So this bank pays me a higher interest rate. This bank has a good online platform. This bank, I love their bill pay. This bank is down the street from my house and it's convenient. Those are usually the reasons you pick a bank, but your money goes in the bank. Then what happens? From that bank account, you do a couple things. Number one, you decide how much you're going to save. Okay, so let's just say you're saving up because you want to buy a car. So I'm just going to draw a car here. You're saving up money because you want to buy this new automobile here. Okay, and when this is a pretty fancy sports car, we'll just kind of do that. I know that's a bit rough, but you know, my drawing days work better when I got time. So you're saving up. So you're putting money in a savings account, and let's just pretend that your savings account is paying you 4%. I know that's a bit high for today, but that's fine. Let's call it 4%. The other thing you're doing is you're paying bills. Okay, so your money from the bank is leaving your family for bills, utilities, and all that. So today, what we're going to do is we're going to focus on just the money that's leaving your family on the debts you have. And a lot of times bills are paid with debt. You're using credit cards to pay for debts, and then you're using the bank to pay off the credit card. So you see, everything's exactly the same. But is this not what you're doing with your money? And I know some of you are going to say, well, wait a second, before I get the money, Chris, I'm putting money in a 401k. Put a pin in that. I could go a whole session just on that, but I'll come back to that in another video. But today I just want to talk about the money that's going into the bank account. And I want to really get finite and talk about the money that you're saving to buy a car. Now, if you're saving up to buy a car, it's going to take you time. You have to capitalize that banking system so that you save up enough money. And let's just, I don't know, let's pick just a normal automobile, 25,000 bucks. I'm not really sure what kind of brand new car you can get for 25 grand, but I'm sure someone else knows that there's one. Now, what if this process could be done differently? But all you had to do is change one thing. And I'm going to say what that one thing is. And I'm just going to say, I'm going to put a question mark. What is this mystery place where all we're going to do is we're just going to change where our savings, not all the money, but instead of putting the savings in the bank, we're going to take our savings and we're going to put it into this different account right here. Okay. Now, what would be the reasons that all of you would potentially make this change and use this account? Let's start with number one. If your bank's giving you 4%, wouldn't you want a higher interest rate than what your bank is paying? So what if this mystery account, and I'm just going to pick the lowest number of the companies that we work with, paid you 5.75%. Now, there should be a couple questions you would ask. First, let's go back to your 4%. Your 4% that you're getting over here is not guaranteed. This 4% can go up, it can go down, and it literally can go to zero. Whatever the Fed decides this rate should be is what that rate's going to be. So now if you were going to say that, you could say, all right, well, even though this new account, whatever this thing's going to be, is paying me 5.75, that's higher than 4, but I don't know, like, could that change? Could they drop it to zero? What if I told you that the minimum you could ever earn is 3.25, guaranteed to never change for the rest of your life? You definitely don't have that in the bank. So I got your attention now. The other part, so the rest of the 5.25 would be in the form of a dividend, because this company, you are going to benefit from the profitability of that company. Okay, and we'll cover that in a second. So I just want you to know 3.25 is the absolute lowest you could ever earn. That is your guaranteed interest. The rest is in the form of a dividend. Okay, so I'm just going to leave 5.75 because now we are beating the traditional bank. But now it gets even better. Over here, when you get paid this 4% at the end of the year, the bank sends you a lovely 1099, which means you have to pay tax on that 4% interest that you earned. So to make it better than the bank, this new account where you're going to change where your savings goes, well, in a perfect world, we'd want that to be tax-free growth. Okay, so tax-free, 5.75. Now over here in the bank, is this money protected against judgments and liens? Heck no. That is the lowest hanging fruit. If you ever got sued or someone wanted to take you, to the cleaners, as they would say, this money is the easiest money to get at a bank. But over here in this one, this money is protected from judgments and liens in almost all states in the United States of America. Now, you can check that. Now, some have limited protection, some are unlimited. That's all you need to know. And also over here on this side, it is private. So even if they wanted to sue you and try to take this money that is protected in most states, they would have to know about it. It is not published. Your bank account? Heck no, that is not private. That is about as public as it gets. If an attorney wanted to know how much money you have in the bank, presto, they find out. Over here, this is private. And in the traditional bank, let's just say you had saved up, let's use 30 grand. Okay, you saved up $30,000 in your traditional bank, and the number's irrelevant. I'm just picking a number out of the sky. That $30,000, if you died the next day, how much money would your family get? Stupid question, because your family would get 30,000 minus any of the probatable stuff. But over here, if you put 30,000 into this account, you would probably have, and I'm just going to make up a number, but let's just say 250,000 plus that would go to your family for a legacy. So let me just ask you this. If we were just to compare these two, which one would you want your money in? I mean, like, do we really even need to make that discussion? I think it's pretty clear that this is significantly better than this. That's the first thing I want to cover is the why. So that is the why. So why is it that the wealthiest families throughout history, and I'll just name a couple, the Rockefellers, the Rothschilds, you know those two names, love it or hate them, okay, you know those names, they changed where their money went. But not only that, how about Ray Kroc, okay? McDonald's, you've ever heard of that? That's how, this is where he put the money that funded his real estate, and also the Ronald McDonald marketing campaign was funded from this place, okay? How about Walt Disney? You see, back during Walt Disney, when he had this dream of creating Disneyland, banks wouldn't give him that money. They literally thought he was crazy for his idea. But what he did is he had been changing where his money, his savings was going because he was getting ready for this. So when the banks all said no, guess what he did? He became his own bank using this. And I could go on. I mean, I could use lots of other people. I could use McCain before he passed away. He used that to fund his political campaign. Same thing with Biden, love him or hate him. Again, I'm just talking about the wealthy families out there. Why are they using this account when you're being told to use this account? Okay, so just making a point. So now that we've got all this figured out and we understand what this difference is, now let's go into how. First, we talked about the why. And, oh, I should probably tell you what this is instead of being a mystery, right? You're probably all saying, Doc, you got to tell me what this thing is. Well, brace yourself, because all this is a whole life insurance policy, especially designed and engineered whole life, I should point out, from a mutually owned life insurance carrier that pays dividends. You see, there's such a key thing in mutual. Mutual is kind of like a co-op. I mean, it's not, but I'm just trying to make this. You understand a co-op. Everybody kind of pools their money in a co-op and everybody benefits from the success of that co-op. Well, in a mutually owned life insurance company, there are no stockholders because they're mutual. So who benefits from the success of that insurance company? The policy owners. Because the policy owners and the policy holders effectively are kind of treated like the owners of the insurance company because they are the ones that benefit, and they benefit in the form of a dividend, which we already went over. And those dividends, just so you all know, these insurance companies that we're referring to, especially the one with the numbers I gave you, they have paid dividends consecutively every single year for well over 140 years. And the oldest one we have is over 167 years, never missing one dividend payment. Do the math. That means during the Great Depression, they didn't miss a dividend payment. That means during the Great Recession, they didn't miss it. That means during the pandemic, they didn't miss it. They've never missed one. The rate that they pay out has changed, but here's the good news. We are almost at the lowest dividend payouts these insurance companies have ever paid out. So therefore, this is a good time to look at this. All right, let's move on because I spent a lot of time. So remember, now we're going to buy a car. And before you were saving the money in the bank, but now what we're going to do is we now are going to replace the bank, okay, for the savings we're going to do with this car. So now we changed one thing, and that is where our savings went first. They're going into this specially designed, and I'll hit that specially designed in just one sec, whole life insurance company from a mutually owned life insurance company that pays dividends. Okay, that's all this is. So if you did 30,000 into it, this would, and I want to be clear, you don't have to, but to use this example, I'm just assuming somebody had been saving up to buy this car. They wanted to pay cash because they didn't want a payment to a bank. They didn't want to lose the interest. So that's why they were going to save up cash. But you know what? Buying a car for cash is probably one of the worst things you can do, because if you did buy a car, this car, with cash from a bank account or anywhere else, that money you paid for the car is gone. It can never earn for you again. You have lost the opportunity for that money to work for you. And in return, what did you get? You got a car. Does anyone know a car that appreciates in value, especially a $25,000 car? I've never really seen one. And don't go back to the pandemic. That was a weird period of time. So you're buying a car that depreciates, so it's going to lose value. So you put your 25 grand in the car goes down in value, you're probably going to sell it for less than half of what that you paid for it, and you never earn any interest or dividends on that 25 grand that you took out of the account. Well, today we're going to change all that, and we're going to change all that because you are going to become your own banker today. You're going to become the bank. You're no longer going to leak money, and because the bank is using your money to make more. Let me just describe that. Remember, I said you earned money, you put it into the bank. Are you in control of that money? Absolutely not. How do I know that? I know that because when you gave the bank your money, let's just use this 30 grand again, okay? Did the bank have to call you when the bank wanted to lend that money out to somebody else for a loan? Absolutely not. Did they ever have to call you to use your money and ask permission? Never. But indeed, I think you all know that that bank is using your money. Their bank is lending your money out at a much higher rate than what the bank is paying you. If the bank's paying you 4, what are they lending it out at? 6, 7, 8, 9. They're making a spread. So if you wanted to become the bank, remember, the first step is you can't deposit your money in a traditional bank. So therefore, now we found a better place to put our money. So did the wealthy in this specially designed whole life. Okay, but now we don't want to lose the earning potential on money. So here's how it's going to work. We're going to buy this car. We put 30 grand into the policy. So now what we're going to do is we are literally going to copy everything a bank does. We're literally, if we're going to be the bank, just mimic what a bank does, because you all know how a bank works. Simple. When you go to a bank, normally you would take a loan to buy a car. So that's exactly what we're going to do. We're going to go to the insurance company. We're going to click a couple buttons. They're not going to really ask you any questions. And we're going to take a loan from the insurance company at a rate of 5.25, which is what this carrier is, 5.25. Now remember, that insurance carrier is paying you 5.75 gross, and they're going to charge you 5.25 simple. But here, before we move on to what we do with this money, we're going to take a loan to buy this car for $25,000. Some of you are confused right now because you're like, wait a second, Chris, if I've got 30 grand in the account, why wouldn't I just buy the car with the money? Well, remember, I said if you took the money from a bank, you lost the earning potential on that money. So we're not going to lose the earning potential. Therefore, we're not going to use our money. That 30 grand you put into that specially designed whole life, we're going to keep that in there. Why? Well, because we want to make 5.75 tax-free on all of it. But we still want to enjoy our money and we want to use our money. So that's why we're going to borrow $25,000 from the insurance company's general account. So how, I saw something, and I'm going to kind of use this. The insurance company has a giant pool of money, a giant pool, because for hundreds of years, these insurance companies have taken their premiums and put it in the investment earnings and put it into this giant pool of money. And from this pool, they only have to do a couple things: pay expenses, give you your dividends, pay death benefits when people pass away. But if they're not paying death benefits and their expenses don't exceed what they're taking in, and which they don't, that money just sits there. So to the insurance company, this is a really good business proposition, because if you want to take a loan, what the insurance company's got to do is just look at it and say, okay, we're going to give you $25,000 from this pool of money that is going to be earmarked to pay a death benefit when you pass away. Okay, they're going to take that and they're just going to give that money to you to use today. And they're going to charge you interest because they're going to make 5.25, which to an insurance company, that's an equivalent return to what they would get in treasury bonds, which is where a lot of this money, this pool of money goes. So now, just so you understand what they're doing, they're just giving you the money from that giant pool. And then what they're going to do is they're going to look at that death benefit. So it's actually going to be more than that. I'm going to keep the number simple. Let's just say your death benefit is $500,000 in this policy. The insurance company is going to go into your ledger and they're going to subtract $25,000 from your $500 death benefit, which means if you were to pass away the next day, your family would only get $475. Why? Well, because the insurance company loaned you $25,000 of that $500 while you're living, which is pretty unique. The other thing that's unique is how the insurance company charges this $525. They don't make you pay monthly like you would on another debt. The insurance company sends you a bill for the interest one time a year. That's it, on your policy anniversary. This is very important because I'm going to show you a way to literally it's not cheating, but we're going to just call it cheat the system and make a whole bunch more. It's like a cheat code, but it's not a cheat code at all. It's just mathematics. So that's what we're going to do. So now everybody understands, again, why. And now we're going to go into what. We're going to take that loan, and now we're going to buy this car. So now, congratulations, you've bought yourself a $25,000 automobile. And you know why else you should be congratulated? You still have the equivalent of your cash value. So I'm just making an assumption that you got 30,000 in cash value inside your whole life. That 30 grand is still earning interest uninterrupted. So you're winning here, right? You got your car, you're making money on your money, and you're making money on your money at a higher velocity than what you're paying the insurance company. This is going to get even better. This is where some people stop, and that's a mistake, because they got, they feel good, they now have what they want. But here's the deal. Remember I said earlier, if you're going to be the bank, you have to mimic a bank. I don't know a single bank, not one of them, that issues loans to people and then says, hey, you never have to pay me back. Never. Don't worry about it. Just take the money and run. So what does a bank do? Well, a bank charges you principal and interest, and then you would make payments. So if it was a bank, you would be making car payments. We'll just write this, car payments back to their bank. So if we're going to mimic a bank, we're going to do the same thing. Now, follow me. Don't get kind of confused. This is super simple. Let's just say a $25,000 car loan at 6% interest, because that's about the cheapest you're going to get a car loan. Principal and interest is going to be roughly $500 a month. Now, I don't know if that's exactly what it's going to be. I'm just making numbers up in my head, but that's probably pretty accurate. Okay, so you got a $500 payment you would have normally paid to their bank. Now, let me ask you, and Christy, you know this, you've heard me do this before, but if you make a $500 payment on a car loan to a traditional bank, does that $500 go into your account?
No.
No, it goes into the bank's account. And you never get to use that money again because you're just paying the loan back, right? All you have is the car. But we're going to change that today because you took a loan from your bank and you're going to make a $500 payment back to your policy, your bank. And you're going to do that every single month. You're literally going to set up a bill pay with your bank to pay your policy back $500. But here's the biggest difference. That $500, the second it goes into your policy as a loan repayment, you now have that $500 to use the next day. You don't lose it like you do with the bank because you are the bank. That $500 going back into the policy is your money. Think of this like a home equity line of credit. I think you all understand how that works. If you made a principal payment back to your home equity line of credit for $500, Christy, you're the expert in this. How much money would you have to use when that check cleared?
$500.
$500 because you repaid principal, which means the bank, because now you're in a traditional bank, would allow you to use that $500 again. We're doing the same thing, but we're repaying it back to your policy, meaning you now have that. But there's something magical that's happening here. You're repaying the $25,000 loan, okay? So $500 every single month means that you, just like a home equity line of credit, it's no different. Whoops, I don't know why the percentage is in there, month. $500 a month is coming down. So now the first month, you now owe $24,500, dollar for dollar. And some of you are like, well, wait a second, Chris, they're charging $525. But remember, when did I say they were charging you that $525? Not every month.
Right.
One time a year on the policy anniversary. So therefore, every penny of this $500 is going to principal. 100%, which is why you have access to all of it, but it's also repaying the loan, meaning now in the first month, if your payment paid down to $24,500, and let me pause. Why would you not do that? Why would you not pay $500 back to your policy? Some people would say to me, well, they'd be like, well, it's my money. Why would I have to repay it? Why do I have to make a car payment? Think of it not as a car payment. Think of it not as a loan payment. Think of it as forced savings. Doesn't that sound better? You're now being forced to save more money. Does that suck? No, it's actually really cool. I love forced savings, and all of you should, because that means you're saving more money because it's money you're no longer giving away. That's the beauty. Most people have no problem. Well, some have a problem, but most people have no problem making a car payment because they're driving the car like, well, hey, it is what it is. You've been taught to think that way. It is what it is, but it doesn't have to be that way. And here I'm telling you, it's not that way. The $500, I'm not even going to call it a payment anymore. You know what I'm going to call it? I'm going to call it a recapture of your money, because that 500, you would have normally just given that money away to somebody else. So now you're recapturing that 500. That is a forced savings, okay? Which is the recapture.
I have to stop you here because you taught me this just a few weeks ago, because I too wondered what happens, you know, to your money. Why wouldn't you just, you know, let it come off the death benefit and forget it? But when you told me that you're recapturing your money that you already used to purchase the car, to me it's like you never bought the car, because you're just, I'm sorry, I try to wrap my mind around that still, but it's like you really didn't even pay for a car. You're just paying yourself back. That's amazing. Beautiful. Go ahead. Sorry, I just had to throw that in
Oh,
there.
no, I love it. So that's exactly it. So a lot of times, all we need to do is trick our mind into thinking a different way. Let me give you 2 examples. We're putting money into a whole life insurance policy. You know that that is a premium. And a lot of you would say, oh, I got to make a premium payment. But you see, I have changed the way I think about this, because I'm putting money into a specially designed whole life that gives me access to my money immediately in the first 30 days, high early cash value, grows at a higher interest rate, and I get a dividend, all tax-free, protected, private, and I get a benefit for my family if I die. Like, I'm psyched. That to me is not a payment. That to me is a savings. That is a deposit. I'm making a deposit into the insurance company. I'm just going to call it a premium deposit so that I'm compliant for the insurance companies. Doesn't that change how you think about it? You're no longer making a premium payment. You're making a premium deposit. Now, over here, remember we were saying earlier, you're making a $500 payment, loan repayment. Still just doesn't sound good. But like Christy just said, you're not making a loan repayment. Just change the way you think about it. You're recapturing the money you would have given away for the car. And just by doing this, folks, because you're recapturing the money, guess what happens automatically? You get all the money back for the car you just purchased, the car that you're driving, the car that you're enjoying. You get all the money back. And the best part is if you just keep doing this for every future car throughout the rest of your life, you get all the money back for every single car you buy, drive, and own. This is just math. But here's something that we forgot. There's 2 pieces here that I would be remiss to not explain. I started to explain it here. This $500 a month that's going back is repaying the loan, which means you're actually not paying the equivalent of 525. You are, but you're paying 525 on a declining balance. And at the same time, you're earning in this particular insurance company. Again, you might use a different carrier. In our carriers, this is the lowest one, but there is a carrier that pays 6.4, just trying to call it out. Okay, but that's not the one I'm talking about. This carrier is paying you 5.75% dividend crediting rate, which is the interest, the guaranteed interest plus the dividend. Being clear, the guaranteed interest is guaranteed and the dividend is not guaranteed, but they've never missed one. Okay, just want to be clear so I'm compliant. This means your money is going up. One is going down, the one you want to go down, and the other one is compounding up. Wow. And also, there's another thing too that we really want to look at, and I'm going to show you the mathematics behind this repaying that loan and how that works. But let's just do some math. If you just charged yourself 6%, now how I do it is literally when I buy a car, and I love cars. When I buy a car, I go to bankrate.com and I look at what the best rate is from all the banks out there, and it will show you right at the top. It'll show you here's the best rate. Not guaranteeing you're going to be able to qualify for that, but that's the best rate. That's how I pick my rate. I don't complicate this. I'm just like, hey, if the banks are charging 6 and that's the best rate, well, crap, I'm going to charge myself 6 because I would have paid them 6, wouldn't have even griped about it. Actually, would have been thrilled if I got approved at that lowest rate of 6%. You would have probably celebrated. Some of you would have actually probably cracked a bottle of champagne and celebrate. Honey, we just qualified for the lowest interest rate in the market. Can you believe that? Grab the champagne. You here just get to decide and choose when you want to have some champagne because you'd be like, hey, I think the best rate out there is 6%. I'm going to charge 6%. Honey, get the champagne. There you go. It's whatever you want it to be. You are the bank, so therefore you make the rules. The 6% that I'm repaying to myself allows me to do what a bank does. Remember, let's get back to how a bank makes money. A bank makes a spread. A bank pays you 4, charges you 6. They make a spread. Here, it's costing you 5.25% interest to borrow the 25, but you're charging yourself 6, so you make a spread here of 0.75, which I know for some of you are like, oh, that's not much. It actually is over time. And you know what? The funny thing is, do you realize 75 basis points, just using that math, do you realize that's more than you would have earned over the last 10 years in the highest interest rate savings accounts there are? Do a 10-year average, go on Google it, do your own research. 0.43% is what the average was over 10 years. 10 years. You're making more than you would have gotten sitting in the bank, okay? But that's not all you made. You made that just in a spread, the 5.25 minus the 6% you decided to repay yourself, okay? But over here, hold on a second. Did you not still earn the 5.75? Yeah, it's not this or that. It's this and that, because you were earning uninterrupted compounding interest. It's sometimes, I have to say this a few times, Christy. Sometimes I just kind of have to keep repeating myself, because eventually someone's like, oh, now I see. But hold on. Let me just show it to you. I got something really fun here. We're going to show some numbers now, because everybody, I think, understands the concept. But let me pause, Christy. Do you think there's anything I'm missing here, or does that pretty much drive home the simplicity of how this works?
Well, what I just saw was you never paid 25,000 for that car, because you're gaining the 5.75 right there in your example, compound interest. So you're never really paying 25,000 for the car in the first place. That's
Yeah.
amazing. That's
You're really
amazing.
not, but hey, listen, I'm just going to call it what it is. I mean, hey, you're paying for the car, but you're getting all the money back. But you're
Yeah,
just like, hey, you didn't really pay for it. Either
yeah.
way, we're accomplishing the exact same thing. So let me just show you. I got some math, and I want to kind of just walk you folks through it, because this is actually pretty cool. And then we're going to show you the impact of repaying yourself, being your own bank. But I think just to keep this simple, let's show you this right here. This is a real policy. And I've summarized it in an Excel sheet, okay, just to make it easy so we don't have to look at all the numbers on a wall of numbers on the illustration. But this is a real client. His name was Kevin. Okay, he was 38 years old when he came to us. He had a goal of getting into real estate, because I just gave you a car example, but let's just pretend you were a real estate investor and you wanted to buy real estate. So that was Kevin. Kevin had 50 grand sitting in his bank account, and he saw a presentation we did, just like you're seeing today. And he says, ah, now I see why people do this. Hey, Chris, can I take the 50 grand that's sitting in the bank earning interest, and can I move that into one of those fancy dancy, specially designed whole life policies from a mutually owned company that pays dividends? It's a mouthful. And I said, well, sure you can. You could dump 50 grand in one time. And I said, but Kevin, how much are you saving right now? To which he then said, well, I save about $500 a month. And I said, okay, well, let's change where your savings goes as well. Let's dump the 50 grand in, but also put $500 a month into that specially designed whole life. Now, when we ran the math, as you can see, we were not able to get the full $500 a month in. Now, there's some IRS rules, but we got close. $491.25 is what we were able to put into Kevin's policy. So in the first year, let's just do the math. He dumped in 50, and he put $58.95 into the policy. So his total outlay into this policy in the first year was $58,895. So I'm trying to draw this. That's his total cost basis, his total outlay. To which, how much money did he have available in that first year to use? 51. Now, I know some of you are like, wait a second, 58,000 I put in and I can only use 51. That sounds terrible, Chris. Like I want to use all of it. Well, hold on. There is a cost for running that whole life. There's a death benefit. That death benefit that will protect your family. There is a cost for that. So what you're seeing here, there are 3 costs that you're taking witness to. And also, just so you know, this is about 92% of the money he deposited. So most policies we design, especially if there's a dump in, you're going to have them be anywhere between 85 and 92% of the money you put in available in the first year. But here's the thing. Kevin, because he's a real estate investor, can take this 51 grand out of the policy, like I showed you with the car. So he can take a loan for this 51 grand, And he can go out there and buy real estate. He can lend that money. He can invest it. He can pay off credit cards. He can do anything he wants. So let's just say he found a place to take that 51 grand and earn a 10% return. Maybe a private lending deal on a super secure deal, but whatever. He takes 51 grand out and lends it at 10%. That's a pretty good return, and that's a pretty good interest. So, that would earn him some extra money right there. Now, how much money does he have in his policy earning interest and dividends? 51. Remember, he didn't take his money. He took a loan from the insurance company to which they charged him 5.25. But if he's earning 10, he's only paying 5.25 to use the money. He's making, that's right, a nice spread. But he's making that spread plus still earning 5.75 on all of this money, 92%. That's the first year. And first year is always the worst year, okay? Because we don't have time on our side yet. We haven't had any compounding really happen over the first year because we just put the money in. So let's go to the second year. Kevin is now 39. In the second year, he deposits that 491.25 in, so that's 58.95 in the second year. Now, in the second year, even though he took almost all of his money out, 51 of the grand he took out, and he's making 10%, don't forget that. How much did that 58.95 he put in the second year earn him at the end of the year? So 12 months has elapsed. He gets his dividend, and he's earned that interest all year long, which means that 58.95 has grown 7,141. That means he made, okay, because you can't use that full amount. You would subtract these two, which gives you $1,246. That's how much he made that year. So his cash on cash return of what he earned on his deposit he put in, and some of you would be like, well, wait, no, he put in 58.95 plus a new 58. No, he did, but he took 51 of that out. So that money's already working for him at a rate of 10. Okay, so we're just talking about new money. This is the new money. He made $1,246. If you do the math, divide $1,246 into 58.95, you will see his cash on cash return is 21.14%. So it is this that year plus this, not this or this plus this. So I just wanted to show that. And it just gets better every year because this is math. It's called uninterrupted compounding interest. And it wouldn't matter if Kevin took this 7,000 out, made that money go to work again. This return is going to be the same. The only thing he's got to deal with is 5.25% interest on the loan. Okay, that's very important to factor that out. But the 5.25% he's charging, the rule, and how I do this and the rule I teach, is always make sure if you take a loan out, if Kevin took this 7,141, I would ask Kevin, and I would want Kevin asking himself, can I make more than 5.25% on this $7,141? If the answer is yes, then I say go for it. And then you got to measure risk and some other things. But you see, that's the only rule. Now let's go one step further. Okay, I'm going to stop sharing this because I want to show you one other thing. And I want to show you now the impact of paying yourself back. Just like you pay a bank back, I'm going to show you the impact. And Christy, I know you teach this all the time with HELOC, so it's the same thing. Your audience should be really familiar. It's going to be a little bit of a wall of numbers, but I'm going to walk you through this because we're going to go back to that car example. All I did is I ran a calculator here. In this calculator, I'll make it a little bigger so we can look at it. This calculator assumes, I'm going to get my, where's my pen? Assumes we are taking a $25,000 loan from our insurance policy. We are paying the insurance company 5.25%. All the numbers are the same. And then what we're going to do is we're going to make $500 recapture deposits into the policy. See how that sounds better? Kind of like that, Christy. Yeah. $500 recapture deposits. Now, some of you are like, oh, Chris, don't call it that. It's a $500 loan repayment. Indeed, it is. But in my mind, I'm just recapturing $500. I'm depositing that stuff right in my account because, hey, if I can use this $500 that when my check clears, to me, that sounds more like a deposit than it does a payment. So therefore, call it what you want. You know, we can do the compliance thing and be like, oh, hold on, it's a loan repayment to the insurance policy as a, you know, paying down that loan. Or we can just say, it's $500. I'm just recapturing and depositing back into my policy because I can use that money the next day. To each their own. So now let's go through the math. Remember here I showed the 1, but we're down to 24,500 is the loan balance after 1 month of doing this. And it shows the interest and all these, so a lot of extra info, but let's just come right over here. Have any of you ever heard of APR? Christy, what does APR stand for?
Annual percentage rate.
Isn't that probably one of the most important rates we would look at when we're looking at how much a loan is costing us?
Yes.
Absolutely. So look at this. Remember, we started at 5.25 in 1 month. What is our rate? 5.145, because we're only paying 5.25 on 24.5, not 25. But let's just kind of look at this. We go down, and I'm just going to go year by year here. So you can see there's your months, okay? But we can just kind of see where we're at. And I think I have this thing. Let me stop this thing. Where is that? There we go. Boom. All right. So let's kind of come down. So what you can see is on this, these highlighted areas are basically going to show you when we get to a new year. So after the first year, sorry, I'm just trying to clean this sucker up here, clear. After the first year, here we are, still making $500 payments. We have now paid the loan down to $19,642, which the insurance company is charging us 5.25% on that. And when we come over here, what interest rate are we actually paying as an APR? 4.53. I don't think anyone watching this could go out and get any loan anywhere from any bank at 4.53%, unless it was like a 12-month promo or something like that. I'm sorry, but in today's interest rate environment, and just so everybody knows, this is March 10th, 2025, you cannot find a loan for 4.53% unless it's a promo. But hold on, let's go one more month. We're 2 years into this program. Okay, and remember, all these $500 recaptures, all that money's been available to you. But here we go. We've now paid the loan down to $14,529. We still got the automobile in the driveway, and our APR is 4.017. All right, so now we're going to go faster because I think you all can see exactly what is happening here. So now what we're going to do is we're going to scroll down, and we're just going to see where does the rate go the next year. 3.48, 2.97, 2.347, and your loan is now paid off. So now up here, this is the other funny thing, and I didn't get into, it took you less time to pay the loan off than it would have taken you to pay a car loan to a bank, because you're benefiting from the math, not the bank. When you look at a car loan from a bank, it's an amortized loan. You are not doing this. Your bank loan does not look like this for a car loan. This is only if you're doing this through the insurance company, or if you bought a car using a home equity line of credit would be similar, but the home equity line of credit would not give you that compounding on all of this money. This one does. So look at this. Like if we really were to look at this, how many months did it take us to pay this car off? Right there, that was our last payment. Okay, you can see there we had 543. So this month we're there. This is 60 months. Okay, this line is 60 months. So 60, 59, 58, 57, 56, 55. It took us roughly 54 or 55 months to repay ourselves. Notice how I didn't say repay the bank. I said repay our bank. So it took us less time. We got to use the money. We got to save in interest quite significantly. Oh, and that car is in the driveway, bought and paid for, but you got all the money back for the car because you became the bank. You see, this is just math, folks. I didn't want to get complicated. I didn't want to get into fancy numbers or anything else. It should just make sense to all of you because it's so simple, and it is literally everything you're already doing today with just one change and one step.
It's amazing. And while you were talking about the HELOC would cost you more money because you're paying interest on a daily rate in the HELOC. It's not like this where it's charged once a year and then they base your balance off of, what they're going to charge or calculate your interest.
Really good point.
Yeah, the HELOC is charging interest every single month based on, I don't care if you have $10,000 as a balance on day one, and then, day 15, it's zero, you're still going to pay the interest rate on any balance that it was holding for how many ever days. That's not true here because of the way they're doing it on an annual basis like that.
And the
There's
other
so,
thing,
go ahead.
you just got me thinking. I didn't mean to midstream interrupt you, but like the other thing too that's so important is like with the HELOC, you do indeed have a monthly payment. You have to pay that bank, otherwise you go on default. There is
Yes.
no monthly payment here. There's not even a requirement to repay the loan here. The insurance company will never ask you to repay the loan. Now, I know this is tricky, and that's not what you're going to do because you're going to be an honest banker. You're not going to steal from your bank, but they will literally never ask you for that $25,000 back because remember I showed you, they just took your death benefit and they just subtracted 25 grand. To them, they're fine just collecting 5.25%. They don't care if you ever pay them back. The bank on your HELOC absolutely cares.
Yeah. Yeah. You'll get in lots of trouble if you let that go over. So, I mean, it's just common sense when you learn what this does, that you would only use the insurance from now on out. I mean, you would just start funding these policies so that you're taking care of whatever you need to buy, because you're going to have to buy things. And we've heard that Dave Ramsey save 6 months of your income, save a year of your income for that event. Well, save it. I mean, if you're a big saver and that's what you're aimed to do, then save it, but do it in a way that's going to serve you better than any bank could ever serve you. I think that's just awesome. I'm so thankful, for learning this concept myself. I use it. And I'm excited to use it. I'm excited to even get more policies. So I can't thank you enough for taking the time that you do to come in here and to talk about these things with us and lay it out in such elementary terms that there's no way it doesn't make sense. When it comes to one question that I have pop up a lot is, when it comes to your actual death, so you're, 70 years from now, it's time to go. What happens if you have not been using the cash value of these policies and you die? So now, depending on what year you're in, you have a $500,000 death benefit, but you have $50,000 in cash value sitting in the policy. Tell me how that works out at the end.
Sure. Can I just show it? Might be
Sure.
easier if I just show you a policy illustration here. The death benefit is going to climb because you're putting money, and I didn't really get into the specially designed part of it, but you're putting money into a paid up addition rider, which is forcing the death benefit to go up. So like here, this is just an example of somebody putting 5934 into a policy. And then over here, I want you to look at this is the PUA death benefit. So this is showing how much the death benefit is increasing each year. But just look at the death benefit, total net death benefit. Okay, we go from 73,000 to 85 to 97 to 109 to 121, 132, 143, while your cash value is also climbing. So you can see your cash value is climbing from 32, 39, 46. At the same time, you are increasing through paid up additions and the dividends going into paid up additions specifically. You're putting more premium in, which is increasing the death benefit. So you can see this. I mean, this started off as a very small policy, very small, but the death benefit just keeps getting bigger and bigger as time goes by. So I just figured it'd be easier just to show it than to say it.
So I'm not going to use the names for YouTubers that come out and they will literally say that your death benefit does not include any of your cash value. And so your
Well, they're
family
correct in saying that.
benefit.
They are correct in saying that your cash value is not directly impacting your death benefit, but what that one person starts with a D, yeah, and we could figure the rest out, and ends in an R. That person is right in what he's saying, but he's missing the fact that we are specially designing these policies. The paid up additions and the dividends going to the paid up additions has to increase the death benefit. So Dave should call the insurance company and be like, so how should I explain this? Because I'm telling people the death benefit never goes up. You don't get any of that cash value. The cash value increases the dividend, which increases the death benefit. Therefore, your death benefit is indeed going up because your cash value is guaranteed to go up.
Okay,
It's
that's what I
crazy.
thought. That's what I thought, but I get that a lot because they're like, well, I've never wanted to do that because I'm going to lose. My family won't get what I'm actually depositing, but that's not true. Okay,
Not the
so
case at all. No,
thank you
that
for showing that.
person, a lot of people that are watching that person should really understand a lot of his motive, but we won't go there today.
Yeah, I know. All right. Well, I appreciate you so much for coming on again today and running through this with us. Every time that we have these meetings, I learn something that I did not know before. So I'm grateful myself, but I believe that when the American people start catching on to what's happening with their money just sitting in somebody else's bank first off, and then they realize, wait a minute, I have the power to do that, because we don't realize how much power we have with the way those are set up. So I appreciate you so much. People, if you're watching this, please take the time to rewatch these videos, because it comes every time you are watching the video, your mindset is changing. And it takes that. It took me a long time to come into the realization of what's happening here and that it is realistic, because I'm doing it now. And I wouldn't be showing it to you if I wasn't in the process myself of watching this unfold in my own life. And it has been quite an experience. And, you know, when Chris is talking about that you're going to be paying yourself for your car, if you guys could just hear yourself say that, that yes, you're taking your money, paying for a car, and then you're paying yourself back. That's what I kept having go through my head while he was talking, is that you're really buying the car for yourself, from yourself, paying yourself back for your car, and nobody's in between that. That baby percentage rate that you're paying, it doesn't even qualify as an interest rate when you see how you're gaining the compound interest in this account while you're paying down your balance every month. And if you did the math on that, and I don't know that you could do the math on that to exactly know how much interest you pay over the 60-month or 54-month period that you showed there, but the math doesn't math when it comes to the interest, because it's coming down every month that you're putting a payment in. Your compound interest is growing in the dividends. So when you really were to do the math, you're probably not talking about hardly any interest that you're paying for that car. So it just is, I'm just so thankful that the Lord has showed us this wisdom of how the rich people actually use their own money. And I just feel like that it's just a beautiful light at the end of the tunnel that people did not even know were there or was there. So I appreciate you again. Thank you so much. I can't wait to meet with you again and see what you have up your sleeve going to teach us, because you're very good at what you do. And I appreciate you taking the time.
My pleasure. Thank you.
All right, guys, you all have a great rest of your day. Like I said, keep rewatching these videos. You're going to be amazed when the insight really just sticks you and you're like, oh my gosh, that's unbelievable, because it truly is. So I hope that you guys enjoy the videos. I hope you're getting value, and I look forward to seeing you in the next video.